You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mish Shedlock, editor of Mish's Global Economic Trend Analysis. Welcome to the show, Mish.
Pleasure to be back on.
Everybody's blaming China. Even China's blaming Chinese, blaming people for selectively blind, jealous trading.
Yeah, wasn't that a hoot? When you start blaming the shorts, you start blaming the blind, and you start blaming the greedy. It's a sign you're in real trouble and you don't know what to do. Meanwhile, today I proclaimed, I believe we're in recession here, Jim. And today I said the recession has arrived. Factory orders declined 2.9% in December. We're just now getting that report now. But we saw a pretty awful services ISM yesterday. 8 of 18 industries are in contraction. Of course, mining is no surprise. But there were some surprises in the list, like entertainment and food and hospitality. So when the big driver of jobs is new Chipotles going up everywhere, new fast food restaurants everywhere, when that's in decline, I think we're just around the corner. And 8 out of 18 industries, service industries. So now no one can claim it's just manufacturing.
Well, it sounds very similar to what happened to the Romans. They started having gladiators fight to the death to take people's minds off the fact they didn't have enough food.
Well, yeah, that's it. Meanwhile, I'm pondering here if we can actually have a job gain recession. And, in a way, I don't see why not. I was looking at past recessions, 1, 2, 3, 4, 5, 6, 7, 8, the past 8 recessions. There were some pretty big dips in losses in non-farm, payrolls. But I went back and I found one on July, of 1980, where at the bottom of the recession we only lost 378,000 non-farm payrolls. In contrast, in the latest recession, we lost 6.8 million jobs, and it took years actually to recover to get that back above even. So, what would a job gain recession look like? Well, got all these people working 2 part-time jobs, Jim. So, instead of working them 20 hours apiece, maybe they work them 12 hours apiece or 15 hours apiece. And maybe they've got 2 part-time jobs and they don't lose both of them. They lose one of them, but they're still working, so they can't collect unemployment. And what would, the inability to shed workers would certainly sink profits of these companies across the board. And in turn, that would weigh on the stock market. These are the kinds of things that I'm looking at, and the reason why I don't think we're going to see the same amount of job losses as we saw in 2007, 2008 is those jobs we lost were construction related, finance related, mortgage related. Whole segments of the economy were wiped out. We're not seeing that right now. Except in oil, and the big hit there in terms of jobs may have already taken place.
The problem is the people who lost jobs in the oil patch were well-paid people. A job at Starbucks just isn't going to give the economy the same.
Yeah,
gain.
now they're working at McDonald's or someplace if they're working at all. So Yahoo announced massive numbers of layoffs yesterday. I forget the total, but it was a big, decent percentage of the entire workforce. And I think we're going to see more of those kinds of things. And, of course, Walmart announces closing a couple hundred stores, but it's going to try and move those people elsewhere. Well, how do you do that? only reduce everyone's hours. So that's exactly the kind of thing I'm talking about here.
Of course, retail is one of the reasons why North America did well. People could afford to go out and buy those fancy clothes, but the people working in those shops don't make that much money, do they?
No, they don't. And this is going to be another big drain on earnings because the minimum wage rose in a number of states here, and that might not cause anyone to get fired, but it's going to slow, or many. In some instances, it has actually bookstores and the like that have chosen to close because they simply cannot afford those rates. But what it will do for sure is stall building plans. Walmart is, say, thinking about building a new supercenter somewhere, and it looks like it's touch and go, and now they say, you know what? We got to pay these people this much more money. Maybe we can't get the return on the money that we wanted, so they don't build the store. So that's the analysis. That's the unseen analysis that people fail to take into consideration. When they do these studies and they say, well, history shows that rising minimum wages don't cost jobs. Well, guess what? We've got trends in, we're adding new people to the economy every year. Birth rate is still positive in the United States. So, just to handle the increase in population, more people are working and there's more stores and more businesses being created. That doesn't mean that there was not a negative effect of rising minimum wages. I don't see how any economist can dispute it, yet they do constantly.
The price of oil had a nice little bump up in the past week, but how sustainable is that, considering that most storage facilities are just about at capacity?
Yeah, they are. And I saw a report today that explains why we had that big bounce. There was, some hedge funds in triple leveraged negative energy ETFs, and they just rather than unwind their positions slowly, they just dumped the whole damn thing. More than likely, they probably went long oil futures right before they did this, so they probably made out both ways. It's a great game if you're big enough to rig the market this way. So that's what happened. And then oil, right after that liquidation, oil immediately sank back, and there was another bounce following that. My guess was, perhaps a second wave of bailouts in these triple leveraged ETFs. So, in a sense, if that's all this is, if this is just nothing more, than a short covering rally, which is apparently all that it is, there's a vacuum below, and maybe we see in the not too distant future even lower prices. Of course, a lot of this all depends on talk. I mean, is there going to be a production cutback in Russia and in OPEC, Iran, Saudi Arabia? So far, that's just talk. If they actually manage to do that, that might provide a little bit of a lift to the market. But in a sense, we've got a relative glut of oil here, certainly in storage and certainly in relation to a slowing global economy.
Yes, I don't think you can buy enough SUVs to soak up all that extra oil because, of course, the SUVs are much more fuel efficient than they used to be.
That's part of it, but those have been slow and gradual changes. Rising fuel economy has certainly nothing to do with a 50% plunge in the price of oil in the last year.
Also, too, even though the price of oil is down, you think that would boost consumption. Yet I'm seeing more and more new technology when it comes to electronic vehicles. In the Netherlands, they've developed a plastic coating that's essentially a solar cell that goes on top of your highways and bike paths.
Well, I don't know how, and not certainly that I don't know what that technology is or does, but most of these things only exist with government subsidies, and if it takes government subsidies to make something viable, well, guess what? It's not really economically viable.
Well, with all this doom and gloom, Mish, is there any bright light for investors, or do you just take your cash home and hope that the banks don't turn to negative interest rates like they have in Europe and Japan?
Gold is looking really good here now. It's acting quite well. The gold miners, my gosh, Goldcorp and Newmont were up 8 and 10% yesterday. They're up another 5% today. Market's still going, so don't have any final numbers on that yet. They've fallen so far though over the last couple of years. So is this or not? I think it is, and I've thought so erroneously a couple of times in the past. But we're on the verge here of a recession. The U.S. is talking negative interest rates. The dollar has fallen precipitously in the last week. Mario Draghi's promising more stimulus. The Bank of Japan is promising more stimulus. China's battling the shorts on the yuan. We have the potential backdrop of a currency crisis of some sort, and this entire environment now is a beneficial one for gold. So if you've not bought into gold yet, then that would be my recommendation to get in now.
And of course, considering how much it has not gone up in price, it's affordable.
That's right. You actually want to be buying things that are beaten up. There's probably some values in the energy sector if you can find some companies that have good properties and they're not deep in debt. The thing to avoid here now with the energy sector is you're going to need to be very discriminatory. You don't want to buy something with a high yield that's going to go bankrupt. That doesn't do you any good. So search around for some companies that don't have a lot of debt or whose debt position is guaranteed to be sustainable. And I don't know when those companies rise back up, but at least you're buying some good solid assets here. The oil's not going to zero.
Real estate. In Vancouver, we've seen property values skyrocket over the last couple of years. Is that money from China going to continue to flow to North America, or are they going to hoard it just because times are going to turn bad back in China?
It's already stopped. West Coast buyers in the U.S. have given up. We've got huge multi-million-dollar properties in California that are sitting there vacant with no buyers. They expected Chinese buyers to come in. Guess what? China has really tightened its capital controls now. The Chinese stock market has crashed. People who felt really wealthy now no longer feel so wealthy, and they're having a hard time getting their money out. So I would suspect you're either seeing now or will soon see the exact same kind of thing in Vancouver. We're also seeing it on the East Coast in the United States. Buyers that were buying condos from Latin America, that they're buying them in Florida, have now decided, you know what, the dollar has risen so much compared to their local currencies that they can no longer afford to buy these units. So that's what we're seeing. So I think the tip we're close to another local top if we're not at one here in real estate in the U.S. And of course, China just kept on going to unimagined heights, and that crash is going to really affect Canada in the bubble areas in a very profound way.
Well, like they said, the most expensive properties that have gone up the most in price will be the ones to crash first and will lose millions.
That's right. With junk bonds, the rot starts with the junkiest. In the home market, we see buyers of say $100,000 house. I wouldn't buy you anything in Vancouver, or of $1 million house. That still doesn't buy you much in Vancouver, but it'll buy you a lot in many cities in the U.S. So that price, goes from $1 million down to say $900,000. Well, homes that were selling for $900,000 now have to drop to $820,000 or $850,000, and those that were going for $850,000, now can only get $738,000. So that's the progression. It starts at the high end and works its way down, and we're starting to see that now with price reductions and an increasing inventory of $1 million mansions that can't be sold, and so that rot is going to set in there at the high end, and it's going to work its way lower and lower and lower and lower. That's just the way it works.
Mish, if you had an overall message right now, what would it be?
I'd say get the hell out of the stock market, buy a little gold, and be prepared for a recession in the U.S., because actually I think we're in it already.
Mish, thank you very much for chatting with us.
Pleasure to be on.
You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.